Welcome to the fourth video in our series, Understanding Inflation and Escalation in Defense Acquisition, a guide for better public understanding. Today, we will present in detail how real price change affects Department of Defense cost estimates, and how to approximate real price change. Let's begin. If you recall, escalation contains two components, inflation and real price change. In the last video, we discussed inflation and began to introduce the other component, real price change. As discussed, the $128 billion estimate reflects a realistic cost estimate for the Columbia-class program and the expected amount of dollars that will leave the Treasury. The $100 billion estimate reflects the $128 billion estimate without the effects of inflation over the program's acquisition period, but continues to expose the effects of real price change. In other words, escalation incorporates both the effects of inflation and the real price change. Another way to see how escalation incorporates inflation and real price change is to represent it in graphical form. To start, recall that all programs have a base cost, essentially what it would cost to buy each unit of the program if the cost never changed over time. On top of the base cost, the program is affected by escalation. Notice how the cumulative effects of escalation on the Columbia-class program are a combination of inflation and real price change. That is because real price change is calculated from a combination of escalation and inflation over a period of time. Now, let's go over a simplified example of the role that real price change plays in price changes over time. Let's take our three favorite goods in the market: apples, computers, and submarines. At the end of year one, each product has an actual observable price. To keep it simple, let's say an apple costs $1, a computer costs $100, and, well, an inexpensive submarine costs $1,000. Let us assume that we are provided the economy's inflation rate from an authoritative source. Suppose a 3% inflation rate in year two. Because the purchasing power of the dollar decreased 3% in year two, it is forecasted that the prices of all goods and services in the economy will rise 3%. Note that these price changes are assumed, not observed. However, actual market conditions vary for each good and service respectively, and the observed prices in year two, as affected by escalation, may not match to the forecasted prices according to the change in the purchasing power of the dollar. Notice how the observed price of the computer in year two has actually decreased, and the observed price for the apple matches the price forecasted by inflation. The difference between the forecasted price changes due to the change in the purchasing power of the dollar, which is represented by inflation, and the observed price changes, which is represented by escalation, approximates the real price change. For the apple, the observed price change was 3%, while the forecasted effects of inflation were also 3%. Because the effects of escalation and inflation matched, the real price change for the apple is 0%. For the computer, escalation was negative 5%. The forecasted effects of inflation were positive 3%. The difference between inflation and escalation approximates a real price change of negative 8%. For our inexpensive submarine, escalation was positive 7%, and the forecasted effects of inflation were also positive 3%. Because escalation was greater than inflation, the real price change is approximately positive 4%. Thank you for watching. This concludes video 4 in our series, Understanding Inflation and Escalation in Defense Acquisition, a guide for better public understanding. For more information or additional resources on how inflation and escalation are used in defense acquisition, please visit our website at cade.osd.mil/policy/inflation.